Okay, good afternoon and welcome back everyone to our Thursday evening um, options education webinar session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we have a very special webinar because it's earnings seasons again. And we're here to talk about how to trade earnings using options, specifically talking about how to utilize options to leverage the moves that we currently see around earnings season, but do so in a way with limited risk. Now, this earnings season is a little different than most others' earnings seasons in terms of the fact that we are in what we consider an information vacuum. Companies have pulled their revenue guidance and earnings guidance for 2020. So we have a lack of information from many companies. So right now, this is really our first glimpse into the impact that COVID-19 has actually had on our corporate profits. So we do have some idea as far as what expectations are going to be. We have 1 week of reports so far, which does encompass almost 20% of the S&P 500 as far as market cap goes. So we have a little bit of information, and we have some information as to how markets have reacted to that. So we want to talk a little bit about how option pricing works around earnings so that you understand whether if you're buying or selling a call or put, how it's affected by earnings, because those are important things to remember when you're trading earnings using options. So let's go ahead and get started. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So today, what we're going to do is we're going to start off by talking a little bit about the Q2 earnings preview. We'll talk a little bit about what happened in Q1, what the impact of those few weeks in March had on corporate profits, what we're expecting for Q2. March gave us some indication as far as the amount that COVID-19 has affected earnings, but also gave us some information as far as how stocks are reacting to those types of moves. Then we'll talk a little bit about our option strategies, how our option strategies affected by earnings, and which ones should we look at utilizing for earnings events. So we'll talk a little bit about both buying and selling options. What are the benefits? What are the pros and cons of each one going into an earnings announcement? Then we'll talk a little bit about options pricing around earnings. And then we'll take a look at the earnings calendar, the upcoming earnings calendar, how we want to use that earnings calendar specifically for options trading. And lastly, we'll try to go through as many live examples as possible. And at the end, we'll try to answer your questions regarding earnings or the upcoming earnings season. So before I jump into starting this, I just want to make sure everyone can hear me loud and clear. Please type 1 into the chat window if you can see me and hear me loud and clear. Okay, perfect. I see a lot of ones. Great. So the question that I want to help investors answer as a result of today's webinar is really, how can I trade this earnings season with limited risk utilizing options? And the key word here being limited risk, because whenever we're trading earnings, we can trade the underlying stock itself, but the concern about trading the stock itself is that if you have a big adverse move, that could lead to a very large loss almost instantaneously or overnight on the earnings announcement. So what we want to do is we want to be able to take those directional views that we have in the markets and trade them so that if the trade goes against us, we know that we have a limited amount that we can lose. That you can't do that when you're trading stocks. You only can do that when you're trading options, but there are some limitations and there are some nuances to trading these strategies. So we want to make sure that you understand them before you go deploying them on your portfolio. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. For those of you that are familiar with who I am, my background actually spans about 14 years of market strategy, working with both retail and institutional traders, helping them better understand how to trade the markets and how to analyze the markets. And I leverage a lot of technical analysis for that. But for earnings, this is really where technical analysis kind of goes out the door a little. We do find that many times the earnings event is the catalyst that drives some of the technical analysis that we do. But many times technical analysis kind of goes out the door a little bit around earnings season. We do have to focus a little bit more on the fundamentals. We do have to focus a little bit more on the macro stuff. So I will spend a little bit of time talking about that. And for those of you that want to do a deeper dive into that, join me tomorrow morning, where at 9 a.m. I will be discussing the markets broader in terms specifically around an earnings season, what type of ideas I'm currently looking at, and also from a macro perspective, how we're looking at this particular earnings season. So a lot of content that we provide for you guys to help you better understand and navigate this earnings season. So today, let's first start off by talking about Q1 and Q2. So Q1 earnings was back in April. This is really where we started to see the beginnings of COVID-19 and how that affected corporate profits. So we ended Q1 earnings with roughly about a 15% decline in earnings per share growth for the S&P 500. So 15% decline. So that roughly 3 to 4 weeks of lockdown, if you will, from early March to the end of March, that accounted for about a 15% decline in corporate profits. That was one of the worst declines for a single quarter. Now, that was when we were expecting roughly about a 10 to 13% decline. So EPS, earnings per share, came in a little bit lower than analysts' expectations at the beginning of that quarter. Energy, surprisingly, was the strongest sector in terms of number of beats, and both on earnings and on revenue. Discretionary was the weakest. Discretionary was the one that took the largest hit. That wasn't, and that's not particularly surprising because it was discretionary stores that basically closed entirely for those few weeks at the beginning of March for across the whole country. So one of the things that I think is most important to look at is not necessarily how companies perform, but how do the markets react to that performance. So what we saw was that the average stock when the stock beat in earnings and revenue, there was a fairly average move as a result of that, meaning we didn't see outsized moves or undersized moves. It was pretty much on average, it moved on average. However, when stocks missed on earnings in Q1, we didn't really see any major negative reactions. And that was the sign that markets were near a bottom, markets were forward-looking, and they were no longer taking on that bad news as a reason to sell that particular stock. And partially that was because markets were pretty heavily oversold back in late March, early April. So we didn't really see some big moves to the downside as a result of stocks missing their earnings. And that's important to remember in terms of looking at Q2. Now, looking at Q2, this is the monster quarter. We're expecting roughly somewhere between 40 to 44% reduction in EPS. Compare that to the 15%, we're talking about 3 times the decline in terms of earnings per share on S&P 500 stocks compared to Q1. So again, Q2 we know for a fact is going to be the worst quarter. Now, markets are forward-looking. Markets are not just focused on Q2 earnings. They're already looking at Q3, Q4, what they're expecting for the full year and kind of what that pace of that recovery is going to look like. Now, the challenge here is the fact that we really have a lack of information. Normally, we have a vast majority of the S&P 500 names providing guidance with what they're expecting for the next quarter, what they're expecting for the full year in terms of revenue. We now have only about 120 to 150 stocks out of the whole S&P 500 that's providing any form of guidance in terms of expectations on revenue and earnings per share. So that is a huge lack of information that we currently have in the market. So any type of information that stocks are going to provide, that is likely what's going to provide any type of outperformance or underperformance as a result of it. I would argue that in this particular quarter, whether a stock really beats or misses their earnings expectations is going to not necessarily affect the stock very much. But if they have language around how they think the full year is going to look like, that is more likely going to drive any type of outperformance or underperformance under the stock. And we'll show you some of the names that have reported so far this quarter, and we see that. We've seen stocks that have blown it out of the water that are basically trading at the same price they were trading right before earnings. We also have seen some misses that are still trading near their prices. So the lack of information is really what we are looking for more than anything else in terms of earnings per share or revenue. right now there's a very large dispersion in terms of estimates, and beats are likely going to see muted gains. And that's exactly what we're seeing so far in the stocks that have reported this week. This is really the first week that earnings season has kicked off in any type of significant way in terms of stocks that have a significant market cap. This is the first week that they have reported. So we'll take a look at some of those names, but like I said, what we see last quarter and what we're seeing this quarter is really stocks beat or miss. Stocks aren't moving a whole lot on earnings. So we don't necessarily expect to see a big moves up or down from this particular earnings season. And that is going to favor certain option strategies. And we're going to talk about that in a few minutes. So what sectors screen well here for Q2? What we look at is revisions in terms of our analysts revising their estimates going into earnings. Which sectors have seen the highest upward revisions, where they looked at their guidance and they said, well, we think that these companies actually made a little bit more than we were originally expecting. We saw a fair amount of revision upward in healthcare and in staples. And this is not surprising from a fundamental perspective. Healthcare, we've been talking about healthcare for weeks. We've been looking at we are long IBB, which we just got out of that position earlier today. We like the healthcare space, specifically the pharma space. That's really the subsector, if you will, within healthcare that we really like. Staples, also not surprising that Staples is doing well because of defensive nature that Staple has, and the fact that during COVID-19, a lot of people have been stocking up on goods and not eating out. So Staples, certainly one of the sectors that have been a net beneficiary of all of this. And where we're seeing some downward revisions, actually, energy was the strongest sector last quarter. We are now seeing some fairly significant downward revisions in energy and consumer discretionary, which also is not particularly surprising. And because right now consumer discretionary is becoming more and more focused in just a couple of names. You have Amazon, Home Depot, and McDonald's and Starbucks really rounding out almost half of that index. And then you still have another 60, 70 names that make up a very, very small portion of that index. So most of those 60 to 70 names are where we see most of the downward revisions in terms of earnings per share within the consumer discretionary space, while you have Amazon, Home Depot, Lowe's seeing some upward revisions, but again, they are just a few names that have very strong, a very concentrated market cap within that particular sector. Utilities also scanning fairly weak here. Utilities, one of the weakest last quarter, and is looking particularly weak in going into this particular earnings announcement. So that is just a quick overview of what our expectations are for last quarter and what we're expecting going into this particular earnings season. So not a whole lot that we're expecting in terms of movement, but certainly a lot in terms of information that we've been lacking so far. So let's talk a little bit about trading earnings. So first of all, just a quick recap, what are earnings to begin with? Earnings is really where a company reports their quarterly revenue, their profits in terms of their earnings per share, and they try to provide some forward guidance. Now, this is the part that we have lacked. Forward guidance arguably is really the part of the information that really drives the outperformance or underperformance after the stock reports earnings. This is what we're looking for some information on, but we don't expect a whole lot from companies, partially because companies themselves do not have a lot of visibility into what the Q3 and Q4 earnings and how the recoveries go, the shape of that recovery is going to look like. So any type of information is going to be good for this particular quarter. Now, why should you trade earnings, or why should you care about earnings? Number one, it creates what we call a very volatile binary event, because when the market expects something and the company reports something drastically different from what's expected, the stock usually will make a big move higher or lower as a result of how far the actual report is. I apologize for that. Looks like I was disconnected there for a second. If you can hear me loud and clear, please type 1 into the chat window. I apologize for that. One of the challenges of working from home. So why should we trade earnings, or what is the reason for why we look at earnings? And it's really because earnings provide this large binary event where we have market has an expectation as far as where earnings will be. And if that report comes out to be significantly either higher or lower from that expectation, you have this volatile event where the stock basically instantly reprices based on that new information. And that instant repricing provides opportunity. Now, volatility is something that you either love or you hate. So today what we really want to talk about is how can you harvest that volatility? How can you trade that volatility, but do so in a way with limited risk? Because if you get the direction of that earnings expectation correct, you can make a lot of money very, very quickly. But on the same token, if you get that wrong, you can lose a lot of money very, very quickly. So what we want to do is we want to see how can we use options to position ourselves where we can be on the right side if we do get the correct view on that move. And then on the flip side, if we're wrong, we have a limited amount of capital that we are risking or putting at risk for that particular trade. And that's really where options comes into play. So what we want to talk about is how you can buy, call, and put options that give you leverage on the directional view, but do so in a way with limited risk. And there's two primary strategies that we're going to be taking a look at. One is call options. The other one is put options. Now, most of you here on this webinar should have a basic understanding of calls and puts. Calls are for stocks that you believe are going to be strong stocks that are going to beat on earnings. Put options are for weak stocks that you think are going to miss on earnings. So we're going to talk a little bit about each one of these strategies, but before I do, before we look at the strategies themselves, what I want to first review, and this is one of the most important lessons that I think that everyone needs to learn before you can trade options, is understanding how options pricing is affected by an earnings announcement. So whenever we're talking about buying an option, and buying an option means we're either buying a call or buying a put. Buying a call gives us a strategy that looks like this. A put gives us a strategy that looks like that. And both strategies give us unlimited upside if we're on the call side and unlimited downside on the put side. But both strategies have limited losses. So no matter what happens, if we get the direction wrong, we have limited losses. Now, when you buy a call or a put going into earnings, this is what I call one step forward, two steps back. Meaning, when you're buying a call or a put going into earnings, you have one thing that can potentially work in your favor while you have two things that are constantly dragging you back. And it's important that you understand what those two things are to help you minimize it and help you potentially offset some of that to some degree. At the end of the day, you can't offset it completely. You can't possibly avoid it, but it's important that you understand what they are and hopefully a little bit as far as how to measure it so that you can get a sense for whether this is the right strategy for you. So whenever you're buying a call or a put, what you effectively have is two things that are always working against you, and that's volatility crush and time decay. So time decay is something that we're all familiar with. I think anyone who here has ever bought a call or a put is aware of the fact that the value of your call or a put is going to erode and decay as you approach options expiration. So as long as you hold on to that call or a put, the value of that call or a put is going to erode in terms of value. One of the ways you can avoid some of that is by buying an in-the-money call or a put, because in-the-money calls or puts have relatively small amount of intrinsic value, which is what's going to erode away if time goes by. Now, the second aspect that you normally don't have to deal with when you're just buying a call or a put in normal circumstances is what we call volatility crush, because what happens is prior to the earnings event, there's a lot of uncertainties as what's going to happen between now and the earnings, or what's going to happen as far as the earnings event. So naturally, the call and put prices are going to be elevated because market participants that are selling you this call or put need to basically cover their asses, if you will, by whenever they're selling a call or a put to you, because there's the potential that they might lose big on this particular trade. They're going to ask for more for that call or put because there's more uncertainty. So when you buy a call or put going into earnings, you're going to be paying a little bit more. Now, once that earnings announcement comes out, that uncertainty is gone. So that premium that you're effectively paying for that uncertainty gets evaporated. So the value of your call or put is, with everything else held constant, meaning if the stock does not move at all, the value of that put will, or call or put, will actually decrease in a little bit. And this is what we call volatility crush, because the implied volatility in option prior to earnings is going to be elevated, and it's going to decline right after the earnings announcement. So you have these two factors that are always working against you: implied volatility and time decay. Now, what you have to do is that if you want to make money buying a call or put going to earnings, is that you better get the direction correct. Not only do you have to get the direction correct, you need to have a fairly large move in that direction. So this is really where I call, if you get the direction of the stock correct and you get the magnitude correct, meaning not only do you believe that the stock's going to go higher, it's going to go significantly higher, that's really where we call it one step forward, two steps back, because you have one thing potentially working in your favor when you get the direction correct, right? So if you buy a call option and the stock rockets higher, then the amount that you gain from that large move has to overcome what you've lost to volatility crush and to time decay. So you have two things working against you, one thing potentially working in your favor. Now, the challenge here is that you could get the direction incorrect. There's the possibility that you think that the stock's going to go higher, but instead that stock moves lower. So in this particular case, if you get the stock direction correct, then all three things are going to work against you, and you're basically going to lose most of the value of what you buy in terms of that call or put. So this is the challenge around trading earnings, right? Even if you get the direction correct, you can still lose money if the move that you're expecting is smaller than what you're losing to volatility crush and time decay. Only if you get the direction and the magnitude correct, do you even have an opportunity of making money. That's the challenge of buying a call or put going into earnings. And everyone needs to understand this, because a lot of people feel that, hey, calls is a great way to protect myself. I have limited losses. I have leverage to the upside. Yes, that is true. But the challenge here is that you have two other factors working against you, and these things aren't always easy to overcome. So I want to make sure everyone understands this before they go out and buy a call or a put going to earnings, that you understand that there's two factors always working against you, while only one factor that can potentially work in your favor that could also be working against you if you get the direction or magnitude incorrect. So if you understand this, please type 2 into the chat window. Perfect. Okay, so that covers buying an option, right? So we know that there's two things working against us, one thing potentially working in our favor when we're buying an option. So now let's take a look at selling an option. This is what I call 2 steps forward, one massive potentially step back when you're selling an option. So here's the opposite, right? When you sell an option going to earnings, guess what? The volatility crush and the time decay that we talked about before that works against you when you're buying an option, this starts to work in your favor, because volatility crush, when it decreases in value, when you sell an option, you want it to decrease in value. When you sell an option, you want that time erosion to happen. So a lot of people ask, well, why wouldn't everyone just sell options going into an earnings event? And the answer is because whenever you sell an option, guess what? The risk to reward ratio is the exact opposite, right? The money that you can make on a call option is limited, so you can only make a certain amount when you're selling a call option, but the amount that you can lose is unlimited, right? So if you get the direction correct, you're really screwed, because what you get in terms of volatility and crush and time decay is not a whole lot. It's not like volatility and time decay are going to offset the losses that you have necessarily if the stock makes a big move against you. So one of the challenges here with selling options is that, yes, you have volatility crush working in your favor, you have time decay working in your favor, and if the stock moves in your favor, then yes, you have 3 things working in your favor, which is great. However, if you get the direction wrong, what ends up happening is you get this one really large thing working against you that is going to offset what you've gained in terms of volatility crush and time decay. So it's not that selling options is necessarily bad going into earnings. It's just that you are exposing yourself to a lot more risk. Yes, you have two things working in your favor, but if for whatever reason, and there are plenty of reasons why an earnings play could go against you, right? I would argue that many earnings plays is close to about a 60-40 shot in terms of getting the direction correct. So you have a fair amount chance of just getting the earnings announcement wrong. And many times you can get an earnings announcement correct, but the stock still moves in the opposite direction that you expect it to. And we've seen quite a few of these this earnings season already. So even with those things, you could still get the direction wrong, and that directional wrong, there's no limit as to how much money you can lose. So be careful if you're going to sell options going into earnings. The best thing to do is actually combine buying and selling. And that's what we're going to talk about next, is the actual strategy around trading earnings. But it's important to understand the different factors that are at play when you're trading earnings. So if this makes sense to you, please type 3 into the chat window as far as what the benefits are of selling options, but also at the same time, what are the downsides, or what are the risks that you're taking when you're selling an option going into earnings. Okay, perfect. So now that we talked about volatility crush, we talked about time decay, we talked about the stock moving higher or lower, going either in your favor or against you, we talked about this in theory. Now let's talk a little bit about how can we quantify this, right? So how much money do you actually get from volatility crush? How much money do you actually lose to time decay? How much money do you gain if the stock goes 10% or down 10%? And that's really where we turn to the Greeks. The Greeks allow us to quantify these things that we just talked about it from a theoretical perspective. And there are 3 Greeks that are important for us to know when we're trading earnings, and that's delta, vega, and theta. Delta is the sensitivity of this option price to these changes in the stock price. So this is what we talked about. If the stock makes a big move higher or a big move lower, right? If the stock moves $10 higher or $10 lower, how much does the option price move, right? That's what delta tells us. So if you have a delta of 0.5, and what that tells us is that for every $1 the stock moves, the option will move 50 cents. So if you have a $10 plus move, what happens is that your option will move by $5, half as much, okay? That's how we measure how much options are going to move if the stock moves up or down. Now, Vega tells us the sensitivity of the option price with respect to the change in volatility. That's the volatility crush that we just talked about. So Vega measures how much the option price will move for every 1% change in implied volatility. So if you have a stock that normally trades at about 20% volatility, but prior to earnings, it is trading at an elevated volatility, let's say at 25, then what this is Vega is going to tell you is that when the volatility crush goes from 25 back down to 20, how much does the value of the option decrease by? So if you have a Vega of 0.25 and you have a 5% reduction in implied volatility, what that translates to is a negative $1.25 move in the option. So Vega helps us quantify when that volatility crush comes, how much are we actually going to lose or gain depending on whether we're buying or selling that option. And lastly, theta. Theta helps us measure how much value of the option we lose due to time. So theta is always quoted in terms of the amount that the option will lose for each given day. So if a value, if let's say you hold on to a call option for 7 days, then in this particular case, if you hold on to it for 7 days, then your option will lose 70 cents. So if we added all of these things up, that's how we can get a sense for how much money we gain or lose. So if we bought something for, so if let's say we bought a call option and the stock moved up 10 bucks, we gained $5 from delta. We lost $1.25 to Vega. So in this particular case, we're up $3.75 between the delta and the Vega. And then we lost another 70 cents to theta. So our net profit on this whole trade is $3.05. Now, these are theoretical assumptions that I just made. This is completely made up, but this just gives you a rough sense for how you can roughly calculate what you can expect from the change in terms of your option after earnings. Now, I don't expect you to calculate any of this. This is not something that you should try to learn how to calculate, because OptionsPlay does the calculations for you. That's why we created this platform. I'm just showing this to you from a theoretical perspective so that you get a sense from theory to numbers to actual calculations. And then what we'll show you is how the platform actually does all of this math for you. So if this makes sense to you, the three concepts, delta, theta, and vega, please type 4 into the chat window if that makes sense to you. And if this is completely new to you and you're brand new, I do have a whole webinar just on option Greeks alone. You should take a look at that, but these are also recorded. I have the slides available for everyone so that you can re-watch these again afterwards at your own pace. So now that we talked about theory, we talked about how option prices are affected around earnings. We helped you quantify a little bit around that. Now let's talk a little bit about some of the strategies, meaning what strategies should you actually deploy when you're trading earnings. So when we're trying to pick a strategy, and for those of you that watch CNBC, earnings season just kicked off. During earnings season, we almost exclusively only look at earnings names. So every single week, going for the next 4 or 5 weeks, we're only going to be picking names that are coming up in terms of earnings. We're going to analyze them. We'll show you how we look at those earnings, and you'll see how we pick earnings strategies for those particular names. But generally speaking, when we're looking at earnings, we really classify it based on how much we expect the stock to move. So when we expect a big move, when we expect a modest or slower move, we, based on that, pick a strategy. When we expect a big move, this is really where we typically leverage a strategy like a long call or a long put, because again, this is where we think that the move is going to be big enough to overcome that volatility crush and that time decay. If we expect the stock to be more of a modest or slower move, then we typically pick a strategy more like a vertical spread. So if you look at the spread that I just used on Johnson & Johnson this week, that was a stock that I thought was going to make a sizable move, but fairly limited in terms of how far it can go. And really that comes down to the size of Johnson & Johnson. It's a major company. It's not going to really surprise us, in terms of in a major way, generally speaking, because they're well covered by analysts. They provide a fair amount of guidance throughout the quarter. So we have a good sense for where they're going to report. And so when we expect more of a modest or slower move, we use a strategy like a debit vertical spread. And this combines buying and selling. So we talked about the benefits and pros and cons of buying and selling. And you never want to necessarily be in one camp. If you can combine the two into one, that's when you can really maximize the use of options. And the earnings play that Michael used last week, which was a time spread on Morgan Stanley, he used a calendar spread on Morgan Stanley. This is really a strategy that also when you expect more of a modest or slower move. So all of these strategies are the ones that we typically look at going into an earnings announcement. Generally speaking, we try to enter these 1 to 3 days before the earnings announcement, and we usually exit them between 3 to 5 days after the earnings announcement. So these are, generally speaking, relatively short trades, meaning time decay is usually not a huge factor in these particular trades, simply because we're not in them for very long. Volatility crush absolutely is a significant factor, and the amount that the stock moves is the biggest factor that we are accounting for. So when we have a bullish or bearish move, when we expect the stock to either beat or miss, these are usually the types of strategies that we pick from. And you can watch us all earnings season. You can go to previous earnings seasons. You'll see these are the types of strategies that we typically use going into earnings. Now, there are also some earnings announcements where we basically expect the stock to be fairly strong. We expect the earnings announcement to pretty much come in line with where the market is expecting. This is where we don't necessarily expect the stock to make a big move higher or lower. For these types of strategies, we would use a credit spread, selling a credit spread. And we'll talk a little bit about this on CNBC as well, as far as when we're picking credit spreads, what we're looking for. Going into earnings, we're always trying to maximize the amount of premium that we're collecting on those credit spreads. You'll hear me say that I usually try to collect about 40% of the width of a credit spread. That means that I'm risking usually only about 1.5 to 1. So if I get the the direction incorrect and I just completely goes in the opposite direction, I'm only risking 150% of the premium that I'm collecting. These strategies have limited profit potential, just like the debit spreads and the calendar time spreads. They do put a larger amount at risk. This is one of the challenges with selling going into options, is that you're selling going into earnings, is that you're always going to be risking more money than if you're buying a call or a put. But this is a strategy where volatility crush and time decay works in your favor. All of the other ones that we talked about, debit vertical spreads, calendar spreads, buying calls and puts, that's where volatility and time decay are actually working against us. Whenever we're selling credit spreads, this is where we are putting those in our favor. So credit spreads allow us to sell, generate that volatility crush, generate that time decay, but do so in a way with limited risk. But also these strategies, same thing. We generally enter them 1 to 3 days before earnings, and we usually exit them no more than 3 to 5 days after earnings. These are usually strategies that we don't trade that expire usually about 2 to 3 weeks after earnings. We usually don't pick expiration dates that are significantly longer than the earnings dates, unless we're trading a time spread like a calendar or a diagonal, where the long leg, we are maybe going out maybe a month or two because maybe we expect the stock to make a big move in the long run, but in the short run, we're playing for a more neutral or slow or modest move to the downside. So those are the strategies that we generally want to explore going into earnings. So here is the earnings calendar, and we'll show you how to access this through OptionsPlay here in a couple of minutes. But this is the earnings calendar. So as you can see, this is what reported here today. I saw a note here from someone. I didn't get a chance to take a look at this because it was in the middle of our webinar, but Netflix reported while we were talking. Looks like it was down about 10% after hours. Seems like Netflix missed on that earnings announcement. But for the most part, that was probably the biggest move I've seen out of any name so far. All of the banks, JP Morgan, Goldman Sachs, Bank of America, Morgan Stanley, all of these stocks, despite doing very well compared to what analyst expectations were, did not move at all on earnings. Most of the stocks moved 3-4% and then pulled back 3-4% the very next day. Morgan Stanley is really the only one that's trading higher on earnings. It looks like Netflix is the only one that seems to have a big move to the downside. I will take a look at that. I haven't had a chance to take a look at the Netflix announcement yet. But next week, we have some pretty big names coming up. Now, the earnings calendar is organized for you based on liquidity, because whenever we get into the bulk of earnings season, many times there are 200-300 names that are reporting on a single day. And if you ever look at the earnings calendar, it's really difficult to navigate to see which ones should I focus on, where should I trade options on. The answer is focus on liquidity, because when you're trading earnings, you need to be able to get in and out very quickly. Liquidity is paramount when you're trading earnings. So we built our earnings calendar purely based on liquidity. So you know the ones in green are the most liquid names. You should be able to fill even multi-leg orders at the midpoint without having much trouble getting filled at the midpoint, getting in and out. The ones are in yellow are somewhat liquid, so you might have to move them 5 and 10 cents away from the midpoint, but you should still be able to get in and out of those trades. Anything with a score of 3 that's not color-coded, those names are not liquid. Those are the ones that if you're trading them, you want to be really careful. I, generally speaking, will never trade something that is a 3 going into earnings announcements. Whenever you see me talking about a stock on options action, it is minimum a 1 or a 2. I will not touch the 3s because it's just difficult to get those orders executed around earnings. So next week we have a lot of big names here. You have IBM, Coca-Cola, Lockheed Martin, Philip Morris, Texas Instruments, Microsoft, Tesla, Amazon, Intel, AT&T, Twitter, American Express, Verizon, NEE, which I think is a utilities company. So you have a really big selection of a variety of companies, tech companies, pharmaceuticals, consumer staples, a lot of things to potentially play next week, technology names. So let's take a look at OptionsPlay to analyze some of these plays. Let's look at let's look at Microsoft first, which reports next week. This might be a trade that we might highlight here on options action here next week, or I'm sorry, tomorrow for next week. I particularly like this name. This is the one that we put out a trade here for daily play yesterday. And, you know, I like this play regardless, even if you don't have earnings. You have a very strong uptrend. You've had a few pullbacks here since then. Each pullback has been a buying opportunity. That's exactly what we saw here. That's why we're selling premium here. Now, Microsoft is a big, big cap name, meaning we generally don't see Microsoft rally 15, 20% on earnings. It's just not the type of name that does that. So what we're expecting is more of a modest move here on Microsoft. So the trade that I was looking at is to sell premium. Again, if you look at the history of earnings announcements this particular quarter, if you look at Morgan Stanley, you look at JPM, some of the big names, all of these names, you know, had a decent move here on earnings, 2-3%, and really it's just been hovering around those same levels. You see this on Goldman Sachs, you see it on you know, Goldman, after a big move to the upside, pulled back almost all of it today. Pepsi, same thing, had a pretty good quarter, rallied all the way up to 138, pulled back to 133. These stocks are not making big moves as a result of earnings here. Even stocks that do fairly well on earnings. Delta rise 6-7% yesterday, pulled back another 5% here today. That's the price action we're currently seeing. That's what we're sort of expecting here going into earnings. Microsoft, relatively strong name, going head to head with Amazon with respect to cloud services. They've moved about 50% of their revenue now to purely reoccurring SaaS business. Those are the types of businesses that we like investing in. So that's part of why we like this particular stock. And if you look at the stock, responding very well to the 20-day moving average, every single time getting near that. That's what we were looking for, is another bounce higher, especially going to earnings as a catalyst event. That is the type of event that we typically look for going into earnings. And that's why we were looking at selling premium. Now, the trade that we were looking at yesterday, and you can still trade these types of trades, in my opinion, these are still valid trades, even though it's down about 2% here today. You might want to adjust your strikes a little bit, but you're still collecting a little bit more than 33% of the width. That's what we're looking for when we're selling premium going into an earnings announcement. So these are the types of strategies that we're playing, and what you can do is you can use the P&L simulator to actually simulate the three things that we talked about: delta, vega, and theta. So what we have here is a price slider. The price slider tells you if the stock goes higher or lower, how much gain or loss you should expect from your option strategy. We also have a time slider, because if you expect that the stock to make a big move or a small move or whatever size move that you expect it to, you generally want to time it based on when you expect that move to happen. So it reports earnings here on the 22nd. So if, let's say, by the end of next week, next Friday, the stock is still trading around let's just say 205. And we know that volatility comes down a little after earnings. So we adjust that volatility slider down a little. We can see exactly how much expected profit we have on each given strategy. So this is expecting if the stock stays here around 205. I was expecting the stock to trade a little higher on earnings, maybe to around 215. And this is how we can model roughly how much we would gain from selling a put credit spread in this particular case. If the stock rallies up to 215 by the end of next week, next Friday, and volatility comes down a little from the current volatility around 38 down to about 30. Now, there isn't an exact science as to how much implied volatility is going to come down by, but generally speaking, it's a good rule of thumb to move it from about where it is to roughly halfway down to the bottom is a good starting point, just to estimate roughly how much you would gain from that volatility crush. So as you can see, if the volatility stays the same, I'm looking about $165 in profits. If it comes down a little, I'm looking about $267 in terms of profits. So that gives you a little bit of an idea as far as how to quantify the relationship that the option actually has to this volatility crush that is probably, I would argue, one of the harder things to wrap your head around as far as trading earnings. And you can do this for any option that is reporting earnings here next week. We can take a look at, let's take a look at Lockheed Martin. Where is Lockheed Martin? Okay, let's look at Lockheed Martin. I was looking at Lockheed Martin just because this is one of the fewer names that I am a little bit more bearish on here. It looks like it's rallied a little bit here today. I actually like to see these types of rallies for a short because you generally want to look for these types of rallies going into a short. Now, Pretty big sizable move here to the upside here around 365 or so. So the strategy that I might be looking at here is maybe selling a call vertical spread. And maybe I might sell something a little shorter dated than August 24th, because it does report earnings here on July 21st. So maybe I might sell a July 31st or maybe even a July or August 7th, something along these lines where I'm selling the at the money call, maybe buying a 380 call against it, collecting $5.70 on a $15 wide credit spread. So $5.70 divided by 15 is 38% of the width. So when I'm collecting 38% of the width, I'm risking roughly 1.5 to 1. So if I'm right, I make 570. If I'm wrong, I lose 930. Those are the types of odds I want to skew in my favor as much as possible. The more I'm able to collect on that width, the better it is for my strategy. So now I can also say, well, what happens if Lockheed Martin revisits this 338 low here? 338, that low, a few days after earnings, which is on July 21st. So let's say by the end of next week, and volatility comes down a little. As you can see, if I sold this put credit spread, I'm looking at 92%. I'm going to be able to collect 92% of the premium that I collected here, the 570. 92% of that 570 is 526. Now, if Lockheed Martin doesn't move, let's say it just stays put. If Lockheed Martin here stays put, then I'm looking at about a 7% return. So this gives me a sense for how I can view earnings and take a look at how these events are going to affect the value of my option. And I can compare that to buying a put option. I can compare that to selling a call option. Or I can say, well, what happens if it does reach that 340 level? So as you can see here, if I bought this put option, I'm risking $2,000, while here I'm risking $930. So that's not a fair comparison. Let's make this a little bit more fair. Let's say I'm willing to risk $2,500 here. So let's compare these two strategies. As you can see now, I'm risking roughly the same amount of money between selling this call spread and buying that put spread. Now let's say that what happens if I think this stock is going to decline down to 340? As you can see, if it declines to 340 a few days after earnings and volatility comes down, the two strategies are not too different from each other. This gives me $1,000 in profit. This gives me $1,200 in profit. So then I can use this to see, well, if I think the stock's going to make a bigger move to the downside, I'm better off just buying that put option. I'm going to have time decay and volatility work against me. But if I'm expecting that big of a move, it will overcome that time decay and volatility. And this is something that you can't figure out until you look at it using a tool like this. You can't figure out whether you should buy a put or sell a call by just looking at an option chain. You have to put the two side by side, put in these exact scenarios. When you think the stock's going to make the move, by what time, how big of a move, and also factor into that volatility crush. Because if, let's say, you think Lockheed Martin's going to go down to 350, then you can say, well, I'm certainly better off selling that call spread because I'll make $811 for my $1,800 risk versus only make $460 on my $2,000 risk. And this is how you make a decision as far as which strategy is best suited for you, because in your head, there's no way to conceptualize or figure out by back of the envelope calculations these three factors. These three factors are difficult to calculate even if you have a calculator. It's certainly impossible to calculate them in your head. So if you're thinking about trading earnings and you're thinking about, should I sell, should I buy, should I use a put, should I use a spread, use a tool like this to help you understand each strategy, because these three factors are the most important factors that you need to account for when you're trading earnings. And this tool calculates it for you so that you can actually compare strategies apples to apples and see which one gives you the outcome which one gives you the best outcome for the outlook that you have on the underlying stock. So with that, that covers what I wanted to show you here today. I know I covered a lot of things, everything from theory to numbers to calculations. This takes time to learn. So if this is your first time learning how to trade options, or this is your first time exploring deltas, theta, vegas, that's okay. Take the time to watch the recording, but the tools here are here for you. You can use them to set up calendars, diagonals, all types of strategies, and you can use the P&L simulator, which simulates delta, theta, and Vega. So these three are the three things that I talked about. Like I said, you don't need to know how to calculate them. You just need to say, I think the stock's going to go lower by a certain date, and you need to know that you need to adjust for that volatility crush. Once you do those things, you can use our tool to compare what is your actual gain or loss in those scenarios to help you choose what's the best strategy going into earnings. Because guess what? Even for myself, when I'm looking at a strategy, I have to compare things side by side to say, I'm better off buying that debit spread, or I'm better off selling that credit spread. You can't just know that off the bat. And you certainly shouldn't just make decisions like saying, I like to sell, so I'm always going to sell. Because guess what? If you do that, you're going to underperform a lot of the time. Because if you do expect that stock to make a big move to the downside, guess what? You're giving up almost $800 in profits when you're choosing that put option. I'm sorry, when you're choosing to sell versus buying. So don't just always say, I like buying options or I like selling options. If you do that, guess what? You're going to leave money on the table potentially, and you're certainly going to be potentially taking on a lot more risk than you necessarily need to sometimes. So the best way to figure out what's best for you is to utilize tools like this that will help you better understand that. So with that, that covers what I wanted to share with you here today. Thank you so much for taking the time out here this afternoon. I really hope that you guys find this useful for your trading. So I want to thank our members for supporting us and allowing us to continue doing this and providing this research and educational content for you guys every single week. So if you're on a free trial, you're thinking about joining us, you can do so using this link here on your screen at trade.optionsplay.com/member. Membership is just $75 a month or $500 a year. It gives you access to a wealth of tools, including the platform. And also for you, if you want to access the earnings calendar, it's on your platform. Both the liquidity list and the earnings calendar are both on the platform. So all you have to do is log on to the platform, click on the earnings link, and it'll bring you to this earnings calendar. Very, very important for you to use this, especially going to earnings season. So thank you so much. I hope that you guys find this useful. At this point, what I'll do is I'll open this up for Q&A. We have both a chat window and a Q&A window. If you have a question, please post them into the Q&A window, and I will go through your questions there. So again, thank you so much. I hope that you guys find this useful. So let's take a look at the questions here. Jock is saying, was the McDonald's last week trade meant to go through earnings? Yes, that was meant to go through earnings. I don't know that I'm going to hold it through earnings, but it is an earnings play. Do you think utilities, why do you think utilities are weak? Utilities are weak. I'm not saying utilities are, well, first of all, utilities isn't a particularly strong sector, but when I said utilities scan not very well for earnings is because analyst revisions going into this earnings season, they've been constantly reducing their expectations for utilities. When analysts keep reducing their expectations, that's when we expect those sectors to underperform going into an earnings event. Can you comment on double calendar trade near earnings? I don't know that I have a whole lot to add in terms of double calendars. A double calendar is really a put calendar and a put calendar both in one. I think we may have a double calendar. I may have taken it out just because we have a double diagonal. I think that's what you're referring to, where you're basically buying a call or a put, buying a call and a put diagonal, if you will. So this is a strategy that I would say is somewhat designed similar to a iron condor, where you're basically selling a short-term strangle and you're buying a longer-term strangle. This is more of a volatility-based play rather than a directional play, in my opinion. I don't know that I have a whole lot to add to it, but if you're used to trading iron condors, this really just turns the dials up a little bit more because you're selling a shorter term expiration, which means that you have, generally speaking, a slightly higher time decay that offsets the slower time decay and the longer dated strangle that you own. But that's what a double diagonal or double calendar is effectively doing. If the decrease in earnings and is already in the price and the stock price are barely moving when they report earnings, doesn't that seem like buying options would not be a good move? Absolutely, Mark. If the stock is not moving on earnings, you should not buy a call or a put. If you expect a stock not to move, you should not be buying calls or puts. That's why we would prefer more selling, especially this particular earnings season, unless you think the stock's going to make a sizable move. Now, I bought a debit spread on Johnson & Johnson because the analyst revisions going into this particular earnings event was extremely strong. Now, what we have seen a bit over the past couple of quarters is that stocks have been moving a lot prior to earnings, and the actual earnings event itself hasn't driven a lot of alpha. So we have seen a lot of the moves happen before earnings, which is what we saw this week. When we opened this trade on Johnson & Johnson, it was trading at 142. We had the move all the way up to 148 prior to earnings. So you're absolutely right. If you don't expect the stock to move, you should not be buying a call or a put. Anita's saying, hi, Tony. Oftentimes I have noticed that after earnings, the spread between the bid and ask becomes huge. Even if the earnings go in my favor, I sometimes lose on that spread. How to avoid that? There's only one way to avoid that. Only trade the very liquid names. The very liquid names will not see a huge increase in terms of the earnings announcement. And first of all, earnings, you can't trade them, right? Because they happen either before the market or after the market. And usually, once the market opens afterwards, either the next day or the morning of, give it a few minutes. The opening bid-ask spreads are always going to be wide, but give it a few minutes. They will usually return back to normal after 5-10 minutes after the open. So, but another way to avoid that large spread is only trade the ones in green. Those are the ones that have the smallest spread. Sean is asking, can you offset some of the risk with selling options by using credit spreads? Do you plan to cover that? Yes, that's exactly what I covered. Can you give your perspective of Netflix earnings? So I don't have much to add just because I haven't looked at it yet. Looks like the stock's down about 10% post-market. Again, I haven't had time to look at it, so unfortunately, I just don't have much to add. I can look at it and provide some insights to you guys tomorrow morning on tomorrow morning's Friday morning Outlook session. How do you quantify volatility crush in advance? You can't really quantify it, but like I said, the rule of thumb is usually dragging the volatility slider from where it currently sits to roughly halfway down is usually a good starting point to give you an estimate as far as how much volatility crush is going to affect the value of your option. Have you heard us saying selling shorter dated cover calls will have gamma risk? Can you please explain what you mean by that? So Pradeep, gamma is the sensitivity of delta to an option. So a gamma looks like this when you look at the money. So if you think of this as an at the money strike, gamma is highest at the money. But as you approach expiration, what the gamma risk looks like is exceedingly higher and higher, because basically delta goes from like this during normal but as you approach expiration, delta just looks like a line that looks like that. Basically, delta goes from 0 to 1 very, very quickly because, at expiration, if you have $100 strike price, the difference between making money and losing money on that trade is literally a penny, right? Because if it closes at $100.01, you're going to lose money on that cover call, and the call is going to get called away. If the stock closes at $99.99, you keep the stock and everything is fine, right? So there's a big difference between these two prices, even though they're only 2 cents apart. So that's what we mean high gamma risk, because basically the delta changes from 1 to 0 with just a 1 cent move. So that's what we refer to as gamma risk, meaning the sensitivity of delta as you approach expiration becomes higher and higher for a smaller percentage move. Normally, the stock can move a lot and the gamma is not that sensitive, but as you approach expiration, gamma becomes extremely sensitive. This is something I cover on my beginner, yeah, it is something that I cover on my beginner's options trading course on buying versus selling options. So look up the beginner's trading course on YouTube, and look at the course on buying versus selling options. I covered delta and gamma on that webinar. For Michael's Morgan Stanley trade, do you think we could use a debit spread instead? Yeah, absolutely. So a debit, a calendar spread or a diagonal is just, dialing up the short leg a bit, if you will, on a debit spread. Basically, you're selling a short dated option, which has higher implied volatility. So you get a higher volatility crush on the short dated option, which works in your favor as long as the stock doesn't make a big move against you. Michael is saying, when you have a calendar spread, what is the date option play uses to calculate gain and why? Whenever you talk about a calendar spread, you can only calculate P&L up until the first expiration. That's a limitation of any platform because we simply don't know what the P&L will be because it depends on where it settles on that first expiration. So any platform, whenever we're looking at a calendar spread, is really only calculating for you the P&L up until the first expiration. How far out in time do you go with call and put debit spreads post earnings? So like I said, usually we don't go more than 2 to 3 weeks post the earnings date for an earnings play. If you're playing for something beyond earnings, you certainly can, but if you're just trying to play earnings, you don't want to go too far out. No more than 2 to 3 weeks out post the earnings date. Again, all your questions about Netflix, I would love to answer them, but I haven't taken a look at the earnings event, so I just don't have enough to comment on that. Sorry, guys, I really apologize for that. Again, some of the challenges of working from home. So the question was about iron condors. Let me just find the question here. Please explain neutral iron condor for earnings trading. So iron condors is just a call and a put credit spread. We talked about calls and put credit spreads separately. An iron condor is just both. There's really not a whole lot to add to that other than you're basically trading double. You are short volatility twice, you are short theta twice, but you're also long the wings of that iron condor twice. So if you think the stock's going to be neutral, yes, iron condors can be useful for trading earnings, but keep in mind that you do have double the volatility crush and double the time decay, but you also have 2 legs that you're paying even higher volatility and higher time decay because both of those are further out of the money. So they kind of neutralize themselves a little bit. And that's part of why I'm not a big fan of trading iron condors going into an earnings announcement. I prefer to have more of a directional view on that earnings and play only one side. How can I tell if a company will have modest or explosive announcements to set these up? So John, one of the things that if you watch CNBC that we talk about is looking at how much does the stock historically move versus how much the options are implying the move is going to be. So if we look at Microsoft, so what you can do is you can look at the at-the-money straddle that expires next week. So next week would be July 24th. If we look at a straddle, at the money straddle, short straddle, 203.95. So it's this 1320. So 1320 divided by 203.92, which is the current stock price. So the stock is implying roughly about a 6.4% move here for Microsoft going into earnings next week. Let's see if there's a 2.5. Oh, there's a 202.5 strike, but it's actually closer. Yeah, it's closer to 205. Yeah, so about 6.4% is the implied move going into earnings. Now, you can compare that to what Microsoft has actually moved over the past few quarters. If let's say the average move was 3%, but the market is implying a 6%, that's saying the market is expecting a fairly bigger move than normal. If let's say the average move is 10% and the current implied move is 6%, that's the market saying it's not expecting a big move. So that's one way that we use options to get a sense for whether the market is pricing in an expectation of a big move or not. The other thing we look at is earnings revisions. So our analysts changing their revisions, especially in the last week or two, we usually see some revisions, and especially if those revisions become We see a lot of upward revisions in the last week or two, or downward revisions in the last 2 weeks. That's usually also an indication that a stock will make a sizable move in one direction or another. So those are a few of the data points that we typically look at for trading earnings. Why would some companies report earnings on Saturdays? So Dave, I don't know, but I will tell you, none of the major S&P 500 names will report on Saturdays. They will usually report on Tuesdays through Thursdays. If you look at the earnings calendar, you'll notice that there's very few on Mondays and Fridays. The bulk of them are always on Tuesday, Wednesday, Thursdays. As far as Saturdays, the smaller companies sometimes do that. I don't know why they do that, to be perfectly honest. There's no rule. You can report earnings anytime. You just can't do it during the market hours. Can you talk about an exit strategy for J&J and Starbucks? Sure. J&J, I think we're pretty much at our upper end of the range. Our target was 150. We're at 194.5. Time to take our profits. Starbucks, I'm still holding on to this. Starbucks is the longer term play. It goes all the way out to August. I will say that the stock has not moved in the direction that I expected to, but my longer term thesis on the stock still remains the same. Consumer discretionary, not particularly strong. People are not going back to work anytime soon. $5 lattes, I don't think is in a lot of people's morning commutes. Travel is almost non-existent. Tourism is non-existent here in the US, which is predominantly where Starbucks has almost entirely their exposure into. So my thesis still remains the same. I'm taking this trade. I'm comfortable with the risk that I have on this particular trade. That's why we're in this trade. So I'm holding on to this Starbucks trade for now. I mean, and keep in mind that all of these strategies that we play on daily plays have limited risk. So no matter what happens, you should always be comfortable with losing 100% of that if this trade goes against you. If you're not comfortable losing 100% of the trade on every single trade that you make, you should not be getting into those trades at all. So if on the Starbucks trade, there was a risk of $300-400 per share, if you're not comfortable with that kind of risk, don't get into that trade. If you're selling cover calls for income, is it best to do it before or earnings to capture the volatility premium? Now, we've back tested this. This is a really good question. The question is, if you're selling cover calls and you have the time decay and volatility working in your favor, does that make sense doing it going into earnings? The research on this is resounding no, meaning the increase that you get to the volatility crush and time decay does not offset the typical gains that you have in the underlying stock that goes to offset the gains that you have in time decay and volatility crush. So the answer is no to your question. Where do you set up your preference if you trade for income? So if on the income tab at the very bottom, there's a link there's a button that says income settings right here. You click on that to set your income settings, Ben. Rajiv is asking, do you color butterfly, straddles, strangles in any class? I typically do not, simply because straddles and strangles, number one, we don't sell straddles and strangles because they have unlimited risk to the downside. We don't buy strangles and straddles because those are strategies that you can backtest in 99% of the cases are not profitable in the long run. I have yet to find a strategy that's profitable going long straddles because you basically have twice the time decay working in your favor, working against you. That never works out in the long run. And butterflies are really just straddles and strangles with a wing on top of it to help you offset some of those losses. Butterflies, in my opinion, I've traded one butterfly in all this time in CNBC on Macy's. It's a trade that doesn't move very much because you're predominantly delta neutral and you're basically just short volatility. And, I'm more of a directional player rather than a volatility player. And I certainly don't have the outlook on volatility because we're not volatility traders. We are directional traders here at OptionsPlay. What would you estimate volatility decline normally after earnings? So I spoke about this a little bit, but generally speaking, we move the volatility slider usually about halfway down is usually a good starting point to determine how volatility moves after earnings. Do you not like straddles and strangles? I think I just talked about what are the challenges. First of all, I don't think retail traders, generally speaking, should be selling strangles and straddles. They have unlimited risk. You can get into a lot of trouble doing that. Buying straddles and strangles, I would never recommend that strategy. That is almost always a losing strategy in the long run, because the amount of time decay that you're paying for both the call or input will almost always be less than the move that you actually get on the underlying stock. It looks like analyzing an unbalanced butterfly is not available on OptionsPlay. You absolutely can do an unbalanced butterfly. So you can set up a butterfly, and you can always choose an unbalanced butterfly like that. You can do any type of strategy that you would like here on OptionsPlay. What are your trading rules for calendar spreads during earnings? Can you show an example? So let's use Microsoft as an example. So you should really think of calendars as just really a long call, more so than a calendar, in my opinion. What you're doing is you're trying to reduce the cost of that long call by selling a short-term call, or take advantage of the elevated implied volatility of a short-term option. So let's say I'm bullish on Microsoft here. Let's say I buy the 202.5 call, and what I do is I sell a short-term weekly, let's say a 207.5 or 210 call option against it. Whoops, sell. So what I'm really doing is I'm buying this long-term call for $11.45. That's my view. Is long-term, I think Microsoft's going to go higher. But because this is really expensive going into earnings, what I'm trying to do is I'm trying to offset a portion of that, or a significant portion of that, by selling a short-term option that expires right after earnings that has a high amount of implied volatility, higher volatility than the one that I'm buying. And as you can see here, I'm paying $11.45 for the long call. I'm collecting $4.25 for the short call. I'm offsetting, in this particular case, almost 40% of the cost of that long call. So I'm reducing the cost of my long call by a significant amount. And the only thing that I'm really giving up is if the stock really breaks up about above 210 by my July 10th call option. But any gains above 210 is going to be offset. Any losses above 210 is going to be offset by the 202.5 call. So basically what I'm saying is I'm expecting the stock to move up to 210, but not much further. And that allows this for me to collect the $4.20. And then now I own this August 28 call for only $7.25 versus $11.45. But think of this as a debit trade that costs you $7.25. You get out at 50% loss. So if you lose about 50% of the $7.25, you get out. And you have to manage this after the first expiration. If after the first expiration, the calls expire worthless, the short call, you basically now own the long call. You can choose whether you want to sell another call against it. But generally speaking, you should be happy owning this call at a fairly significant discount. And $7.25 on a $200 stock means that you've only paid 3% of the underlying stock price to buy that call option. So then you manage it just like any other call option, right? Again, if you lose 50%, you cut your losses. If you get to 75 or 100% gain, start taking partial profits on that trade. But think of the calendar spreads as really just a long call where you're reducing the cost of that long call by selling a short dated call against it. Are you still planning to include cover call plays? I'm not sure what you mean by, do I still plan on including cover call plays? We send out cover call plays Monday, Wednesday, Friday to you Monday, Wednesday, Thursdays to you during our market observation emails every single Monday, Wednesday, and Thursday. Prakash sends out the income analysis piece so that you guys have a good view into some of the earnings plays, some of the income plays that we're currently viewing. On the earnings calendar, is there a way to indicate whether an earning is before or after the market close? So Sam, that is something that we're currently working on. We are working with our data provider right now to get that data point. Is replay available? Replays are always available for OptionsPlay. All of our webinars are recorded for you to watch. How would you trade Coca-Cola? I haven't taken a look at Coca-Cola, but I don't expect it to be much different from Pepsi. Perhaps a pop up higher and maybe a decline lower. Coca-Cola, very similar price action to Pepsi, basically just trading sideways here. I would be more neutral here on Coca-Cola. I don't expect Coca-Cola to make a big move higher or a big move lower. I would prefer selling either call or put options, or I'm sorry, call or put credit spreads going into earnings here for Coca-Cola. Do you ever do lotto trades over earnings? I'm not sure what lotto trades are. Ted, if you can clarify. Would you consider an iron condor strategy for earnings? So, I mean, it's not that I wouldn't consider an iron condor. Maybe, you know, Coca-Cola here, because it's trading in the middle of the range, that I would consider an iron condor. Personally, I don't trade iron condors because iron condors is effectively saying that I'm bullish and bearish at the same time. And I'm just never bullish or bearish at the same time. But, you know, here's an example of where I could potentially use an iron condor. Something like this, where if the stock stays within this particular range, I make $50. If it goes outside of the range, I lose $100. You know, those types of risk rewards to me don't look particularly attractive here. But, you know, if you think that it's going to stay between 44 and 48, this might be an iron condor that you might want to trade. But keep in mind, iron condors, you know, usually people think of them as neutral strategies, but they're not really neutral once the stock moves either higher or lower and they become a short volatility play. It becomes much more difficult to manage four legs. Your transaction costs really go through the roof because now you're trading 4 spreads versus 2. It's just a lot more work to manage. And from my perspective, I'd rather trade one side. So for example, when Coca-Cola is near the bottom of that range, I'll sell a put credit spread. Sorry. When I've identified a range like this, my preference here is to sell a put credit spread when it's near the bottom. And then when it reaches that top, I'll sell a call credit spread. And if it reaches to the bottom again, I'll sell another put credit spread. Now, this combination of this call or put might put me in an iron condor as a result of that. But this is really where I'm playing both sides. I'm directionally playing, you know, because I only want to sell puts when something's oversold, and I only want to sell call credit spreads when something's overbought. And something can't be overbought and oversold at the same time. So yes, you can trade iron condors, but you're not maximizing the directional piece of it. You're being delta neutral, but it's not really delta neutral, because once it shifts away from that at the money strike and it starts to move higher, you're directional again. So it's not that I don't like iron condors. I have nothing against iron condors. I just think that if you're going to trade an iron condor, leg into them. Don't trade an iron condor because then you lose the directional piece of that. So I hope that helps people understand why, you know, I don't trade iron condors. What is your prediction on Tesla? Great question. You know, you have to have a completely different mindset when you're investing in Tesla these days. It's not a car company. It's a battery company that just happens to make cars right now. And clearly, there's a bigger vision here for Tesla, and investors seem to be grasping onto that bigger vision. You can't think of this as another car company, because if you think of it as a car company, this stock is way overvalued. But if you think of it as a battery company that just happens to be making cars right now, and will be making, we'll be changing the way that electric grids are going to be working over the next 10, 15 years, then, you know, the valuations aren't so crazy. If you think they're going to completely change the entire trucking industry, you know, if you factor all those things in, that's why the price is currently trading at 1,500. Do I think it'll go to 1,700 again? I don't think I think that's pretty reasonable for this to be back at 1,700 over the next few days. Is Netflix a buy in the dip that will occur tomorrow? Again, I haven't looked at the earnings report. I have to look into a little further. Someone said that it beat on revenue but missed on earnings. My guess is that it's more than just the earnings. It's probably that they missed on, they missed on subscriber growth. That's more likely what happened here. I haven't had a chance to take a look. Let's see if we can have some of these. Looks like streaming subscriptions actually increased. Missed on earnings. Beat on revenue. beat on consensus in terms of earnings. So both of those were higher. And actually was higher in terms of subscription growth. Not really sure why this stock sold off so heavily given those numbers. Again, I'd have to look at this a little further. Any chance I will have Microsoft put to me since the stock is below 204 and we sold the 207.5 put spreads? So Al, whenever you're selling a put credit spread, you always have that risk. But Microsoft, let's see. It pays only a quarterly dividend of 51 cents. So I think your risk is relatively low here because I don't know anyone's going to, and this is part of why we don't hold these put spreads going into expiration, because as you hold them into expiration, your chances of that increases. But right now, your chances are pretty low. Is it possible to talk about tax, at least on a federal level, on option, and what way we can save on taxes? On option level, not donation. I started options this year, make quite a bit, but worry about how much I will owe. Kelvin, I'm not a tax expert. Unfortunately, I really don't have much to add on that in terms of how you can save on taxes. Because as far as I know, there are no loopholes in terms of things that you can do to decrease your tax bill, other than trading index options, which are taxed at 60/40 like futures, as opposed to short-term capital gains. What do you think about Walmart? You know, we just got out of this Walmart trade here this week. It's near that upper band of the range. It hasn't broken out above that 133 yet. I would like to see a breakout above 133. If it breaks out above it, it certainly could take off like Amazon did, but it hasn't broken off just yet. Where can I see the implied volatility on options? It's right here. You can see the current implied volatility, and you can adjust that implied volatility based on your outlook. What play would be most confident in the next couple of weeks? Tyler, that's really hard to say. Putting me on the spot. This is something that we talk about on Friday morning. So Tyler, if you want to learn more about my ideas and what I'm looking at, please join us every Tuesday and Friday morning at 9 a.m. That's what we're doing together, is we're talking about ideas. Very helpful webinar. Thanks. I'm new to options. I'm okay with simple calls or puts, but I don't get verticals or spreads. How do you suggest I learn more? John, I actually have a whole series of webinars on vertical spreads. So you can actually learn about them using those educational events. I have them on debit. I have them on credit spreads. I have them on debit versus credit spreads to help you better understand the difference between the two. So I recommend you to follow us on YouTube, and you can see those there. How can I use OptionsPlay platform on an account with a broker? How can I use OptionsPlay on an account with a broker? Well, it depends on if you have a broker that has OptionsPlay. If you have an account that has, if you have a broker that has OptionsPlay, then you can just use it on their platform. But if you don't, if your broker doesn't have OptionsPlay, all you have to do is hit the trade button, and then you have all the details that you need to enter this trade into your broker's platform. So we give you all the details of each leg, and you can put this into your platform for trading. What is the general rule of thumb of how much the drop in volatility? So that's something I also discussed. Roughly halfway between the current implied volatility to the bottom of the range is usually a good starting point. How long before the recording is sent out? I usually send it out about 30 minutes after we finish each day. Keith, is the Microsoft trade you sent out still good, or does the vertical need to be adjusted? I certainly would adjust the strike prices down a little, down to the 202.5 strike for the put vertical here on Microsoft. PayPal earnings are on the 29th. When is the best time to buy puts? So I would argue a few days before earnings is the best time to buy puts. Usually about a week out is where I would start looking at buying puts on any type of earnings. How much Fibonacci retracement levels help with picking options? Sonia, I don't use Fibonacci retracement levels simply because they are completely subjective to everyone. Anyone can join their Fibonacci levels however they want. You can start here and here. You can start here and there. And depending on where you start, the levels change, right? So that's why I'm not a big fan of using Fibonacci levels. I just don't think that they have a lot of value simply because they're so easy to change. You know, 200-day moving average, you can't change it. The 200-day moving average is the 200-day moving average. There's no subjectivity in that. So that has far more weight, in my opinion, than anything like a Fibonacci level, which is completely just up to how you draw it. Does your trade ideas tab allow you to make sure you are only seeing highly liquid options? So if you want to look at only highly liquid options in the trade ideas tab, choose mega cap names. Those are the names that have that are going to be very liquid. Large cap, you're going to find them okay, but mega cap is really the super liquid ones. Would you consider a ratio back spread strategy for earnings play? Jay, I'll be honest, I've never traded a ratio back spread strategy for earnings, but there's no reason why you couldn't use one for earnings, to be perfectly honest. But if you're talking about a ratio back spread where you're selling it and you do have unlimited risk, as long as you understand that, it's a strategy that you can certainly consider. You know, the thing at the end of the day is that there are so many different combinations of options that you can't possibly cover them all. You know, and people generally like to trade the ones that they're comfortable with, the ones that they understand, but there are so many variations. Even butterflies, you can do variations, put calls, iron butterflies, broken wing butterflies. There's so many different variations. There's all these different reasons of why you use certain ones in certain scenarios. So, you know, a ratio back spread is really kind of like a broken wing butterfly, you know. So there's all different types of ways that you can use these types of strategies. Just make sure that you understand the risks and rewards of each one before you go ahead and utilize them. Google seems to be in a range between 1490 and 1590. Is this a good candidate for a credit spread at the current prices? So as long as you think the stock is going to stay within a range, then they, generally speaking, are good candidates. But again, credit spreads and debit spreads still have a directional view. Your largest exposure in a debit and a credit spread is still delta. So you should still have some kind of directional view. You know, if it trades near the upper bound of that range, sell a call credit spread. If it's near the bottom of the range, sell a put credit spread. You know, if it's dead center, should you put on an iron condor? Again, I argue that you shouldn't, because it's likely going to drift to one side or another, and you're going to lose money on that side. It's going to, and the losses that you have on that side is just going to basically negate the gains that you have on the other side. That's why, again, I'm not a big fan of using iron condors, because again, iron condors still have both sides. Trade both sides. Be tactical about it. That's how you can maximize the iron condor. Can you comment on daily play on Microsoft since it's going across earnings? So my goal actually is to exit this trade before earnings. It's possible that we're going to hold it through earnings. I'm comfortable holding it through earnings, but you know, I was actually expecting that Microsoft would pop into that 215 level over the next few days. We'll see if we get there. If we don't, I am comfortable holding this into earnings. Lisa's asking, on the income tab, how do you determine what strike would you use to make the naked put in a vertical, like on the example in Microsoft? So the naked put on a vertical is always going to be the at the money puts. So we're always selling. So if it's a 203.92, we're always going to sell the first out of the money put. So the 202.5 here would be suitable. How do we find out when the next beginners classes start? Bill, I think the next month in August is actually when we're going to restart the beginners classes. So August is a good time for you to join us if you're a beginner. Can you please give an overview of the type of market data is available on this platform? I'm not sure what you mean by the type of market data. It's US equities is the type of market data that's available. In general, it is sometimes possible to structure an iron condor so that you can collect about 40% on each side. If I find one like this is collecting a possible 80%, if I find one like that is collecting a possible 80%, possibly a good play. It's not really 80% because it's 40% of each side. So you're still doubling your risk as well. So you're not actually collecting 80% weighing on an iron condor. Again, you're only going to be able to find 40% on a credit spread when it's actually at the bottom of the range by selling the put side, you're never going to be able to find an iron condor that collects 40% if you're in the middle of an actual trading range. So I think you'd be lucky to find 30% if that is the case. I don't think you're ever going to be able to find 40% on both sides if you're in the middle of the trading range and you're pretty far evenly split between the put and the call side. What's the difference between VIX and implied volatility? VIX is the implied volatility of the S&P 500. So the VIX is specifically the implied volatility of just the S&P 500. Implied volatility is just implied volatility. You can calculate implied volatility on any stock. Hi, Tony. You always talk about the possibility of a stock put to you if in the money on expiration. Why wouldn't it be put to you much earlier when it goes in the money? Because Barry, if something's in the money, you're better as the buyer of that call or a put. I would make more money selling that call or a put than I would make exercising that call or a put. I actually lose money if I exercise early. So that's why economically it never makes sense to exercise a call or a put early. Where can we follow you on Tuesday and Friday morning? So you can sign up for that at trade.optionsplay.com/weekly. I will post that link into the chat window. So if you want to sign up for Tuesday and Friday morning Outlook sessions, just go to trade.optionsplay.com/weekly, which I just posted into the chat window. How does GS look for put credit spreads after earnings? Let's see. So, you know, from my perspective, put credit spreads are better when they're oversold and you're expecting a bounce, right? Here, Goldman Sachs is near overbought. This is not a good time to sell put credit spreads. This might be a time to sell call credit spreads if you think that Goldman Sachs is going to decline, but you generally don't want to sell put credit spreads near a high. You want to sell put credit spreads near a low, and then you're expecting that bounce higher. Now, if you expect a breakout higher, I would argue that you're better off buying a call option to take advantage of that quick, fast move to the upside. You're not going to be able to take advantage of a quick, fast move by selling a put credit spread. On a vertical trade, which becomes a tight spread with greater quantity versus a wide spread with lower quantity is better. Tyler, so here's the thing. If you trade a vertical spread with a very tight spread, what you have is a very delta neutral trade. So meaning you're not going to make a lot of money if the stock goes significantly higher or significantly lower. So it really depends more on your directional view. I wouldn't argue that one is better than the other. I generally only trade vertical spreads that are wider rather than narrower. I know some people like to trade the narrower ones and trade more contracts, but from my perspective, then you're really making more of a play on volatility rather than direction. So it really just depends on, do you want to play direction or do you want to play volatility? Because volatility, narrower spreads, direction, wider spreads. Can you find ETFs using OptionsPlay? Yeah, absolutely. You can trade any ETF. SPY is an ETF, QQQ is an ETF. Any ETF you can name, you can find on OptionsPlay. What do you look for when picking a strike price? Well, Tyler, that's a bit of an open-ended question. It depends on what I'm picking a strike price for. So, you know, we do have a whole webinar on optimal expiration dates and strike prices where I try to answer that from an overarching perspective. But it really depends on whether you're buying and selling, whether you are, it really depends on whether you're buying and selling and what type of strategy that you're trading, Tyler. What are your thoughts on BABA? I don't really have a strong view here on BABA, but you know, recently broke out above this major 230s resistance level, came back to retest it. Looks like it's potentially moving higher here, but it is trading down into the 242 range, which is near the bottom of that range. So my view here is more bullish. You have a very strong technical score. 1 month and 6 month trends are bullish. This would put me more in the bullish camp here for Alibaba. Barry, you're very welcome. Sunil is asking, how would one identify a stock about to break out versus just at the top of the range? Sunil, hard to say. You know, generally speaking, one of the things I look for is money flow. Strong money flow is usually a good indication of a potential breakout here. So this is Netflix. Notice how before the breakout, money flow was pretty strong. and you got a pretty big move to the upside. Money flow was strong prior to the breakout. That is one of the things that I do look for on a trade, like to tell me whether something, you know, at the end of the day, nothing is a sure bet, but money flow is one of the ones that is worth looking at. What is the study for money flow? It's called Shaken Money Flow. You should find it on most technical analysis packages. Why do, in some instances, multiple option chains appear for a single stock? For example, on SIBO, the RTX shows 3 different chains, some with much higher strike prices. Chances are because RTX recently had a RTX, which is Raytheon, had a some type of corporate action, either a stock split or they merged or something along those lines. Those are usually when you see multiple chains. How do you know how narrow or wide to make a spread in a put or call vertical? It depends on whether you're selling a put or you know, vertical spread. Generally speaking, they're on average anywhere from 25 to 30 deltas apart. Is usually, you know, a debit and credit spread tends to be in that 25 to 35, I would say, deltas apart. That is usually how we measure the distance between the strikes. How about ESG stocks? What are these? ESG stocks are just stocks that have what they call environmental, social, and governance scores. Basically, you know, these are stocks that are, from an environmental perspective, better, from a social perspective. So if you think about diversity and corporate governance, meaning if you look at their board, is their board, you know, all white males, or are they more of a diverse, you know, gender and race group? You know, these are all the things that they typically look for in ESG investing. So the more sustainable the company is, the better they are on an environmental perspective. So it's really scoring how progressive a stock really is. You can Google it. I don't think I'm really doing a great job of explaining ESG, to be perfectly honest, but I do recommend that you Google it and learn a little bit more. It is something that many investors are paying attention to more and more. What is the lower indicator? It is the money flow, the shaken money flow. Can you name a few ETFs or stocks that you see moving in the sector rotation away from tech, and what sectors? So Lisa, I actually just recorded a segment on this Tuesday morning on sector rotation. We looked at all the sectors. We looked at which ones are moving higher, which ones are moving lower. Healthcare certainly is one of the ones that is starting to move a little higher here. So you can check out that on our YouTube channel. I will post the link here. Let's see. Oh, nope, I'm sorry. This week's recording, actually, unfortunately, we lost that. So I don't have that, but healthcare is certainly one of the sectors that we are currently looking at that's rotating out of tech into healthcare, into communications. Those are the top 2 that I'm currently looking at. So with that covers all of the questions that you guys asked here today. I'm glad that I was able to get through all of your questions here today. Normally, I have so many, I can't get through all of them, but I did get through all of them here today. So thank you so much for taking the time out here during the Q&A session. I apologize for the couple of technical issues that we had during the session, but the recording will go out to everyone here in about half an hour. I look forward to seeing you guys there. And I look forward to sharing the recording with you, and I look forward to see you guys tomorrow morning at 9 a.m. bright and early. So thank you so much. Have a great evening, and I'll see you guys tomorrow morning.